certain numbers from 1 to 10. Now, once a setup rating reaches 8, 9, and every once in a great while a 10, listen, those are special opportunities. Those are opportunities to send it in. Not be afraid, not think about risk. Now, risk is a very interesting thing. There's actually, in my view, one particular thing in risk management that stands out way, way above all the rest. And it's not stopping out. It's not about thinking where to stop out. It's not about how much risk you're taking on. It's something unusual, something probably most of you have never thought about. And that is the entry point. Your entry point, before you get into a trade, you prepare. But your entry point, that identifies your risk. For example, how many of you have gotten into a trade which later in the day turned out to be profitable? But yet, because you were early on the trade, you stopped yourself out. It happens to all of us every single day. But if you had a good entry, even the worst possible setup, that stock can't hurt you. So to me, when I started trading, the number one focus was not about risk, but rather risk from an entry point of view. And that is something that I have always strived for, and that has been the strength and the backbone of my trading, is finding out that risk, entry point that's going to give me a great chance not only to make profits, but in case I am wrong, I am not too far from the top where I can stop out harmlessly. Anyway, I'll say a few more things about risk as we go on. Now, before we continue, I want to run a video for you guys. It's an unusual video. Some of you may have seen it. Some of you may not. But I'm sure all of you will find it entertaining. Now, this particular video makes my point very well in terms of, I consider myself a closer. I certainly don't consider myself a piker. And every single person in this room should think of themselves as a closer going forward. Don't have that piker mentality. Now, this video is about real estate. It's from the movie Glengarry Glen Ross. And it's the famous Alec Baldwin speech. So as you watch this video, please think, when he refers to real estate, think of it in terms of trading as stock trading. And when he refers to real estate leads, think of it as trading setups. Right. I hope all of you guys can see the correlation with this real estate video to trading. There's a lot of correlation here. I have seen this video hundreds of times. And each time I see it, it just strikes me, in my heart. I can just feel it. Be a closer. Okay? Find those special opportunities. When you find them, you need to close them. You're not going to close them by trading the same size you usually trade. That makes no sense. When you find a golden setup, you need to attack it. For many, many years, I used to describe my setups in terms of bra cup sizes. And whenever I said, this particular setup is DDD cup, and I'm involved in the size of DDD size, Craig, tell them, what was the percentage of my wins?
I'd say 90s.
90? Maybe even higher. Those were golden. Okay? When I saw those coming, it wasn't about risk. Like I said earlier, it's about the risk of not making enough because this is a golden opportunity. Okay? You need to scale your trading business. Whenever something good comes along, step up to the plate. If it doesn't come along, it's only marginal situation, and you want to trade it, trade your regular size or smaller. That's fine, but you gotta vary it. Those of you that don't have the big picture view like that are willing to settle for mediocrity, I have no respect for you. You gotta earn respect. You gotta have a big picture. That's the only way you're ever going to become a monster at trading. That's the only way you're going to feel good about yourself down the road. You gave it your all. I'll give you an example of a couple of traders that I know. Now this trader I met about 12 years ago. At the time, he made money. He was married, he had 2 infant kids. He was making $50,000, $60,000, $70,000, $80,000 a year. Talked to him many times over the years. And every conversation was almost the same. I said, listen, as your kids get older and older, you're doing okay now, you're making, some gains, fine, great. Your wife's got a nice job, you guys live in a decent house. But what happens down the road? You got, as your kids go to college, you're going to need more and more money. And, you can't settle for mediocrity. You got to have a big picture in mind. So while you are still young, you need to push it a little bit. You can't keep trading the same size. And this trader, for roughly 12 or 13 years, was profitable. Every year he would grind out $50,000, $60,000, $70,000, $80,000 a year. But yet he refused to step up and refused to listen to any of my warnings. And then, one day, he got a divorce. And his kids started living with him. Besides that, he had to pay alimony. His expenses quadrupled. He didn't have his wife's income anymore. And besides all of that, now he had the burden and the pressure of all the expenses and the stress that he had to keep earning. And now all of a sudden, because of that pressure, he didn't have a losing year. He made money, but barely made money in his, 13th year, whatever it was. And because of his expenses, he burned through his trading stake that he used for trading. And he was now out of the job. And instead of trading, which is what he loved, he found himself 3 different jobs, other jobs, just to make ends meet and get by month to month to month. The point is, don't settle for mediocrity. Fuck mediocrity. Have your dreams here. Another trader I've spoken to numerous times. This guy used to, he's successful. He's a smart dude. He makes money. He makes anywhere between $200,000 and $400,000 a year. Many people would find that, wow, that's fabulous. My question to him was, you know what? If you're able to make $200,000 and $400,000 a year, what the hell's preventing you from making $1 million? Or more, or 2, or 3? What's the problem here? Why don't you step up? Well, I got my ways, I'm doing good, I'm happy, And then on top of that, you start bragging and he's got a 50% win rate, but yet he's doing very well. He's able to make $200,000 to $400,000 every year. I said, that's what you're happy about? 50%? What, are you kidding me? You got a 50% win rate, you're overtrading. You're not doing what you're supposed to do. Find the situations that are more advantageous. Those that are only marginal, forget them. Let the idiots trade them. Between these 2 examples I just gave, both of these guys are different, but the story is actually the same. Both guys are settling for mediocrity. One guy was happy for all those years with what he was doing. And one guy is happy with what he's doing now, the next step. Scale it up. Get outside your comfort zone. If your comfort zone is trading 500 shares, okay, no problem. You're comfortable. Okay, get yourself out of that comfort zone. Next month, start trading 600 shares until you start feeling comfortable with that. Another month or 2 or 3 go by. Say to yourself, you know what, screw it. I got to get out of this comfort zone. Go up to 7. Another few months, 8, and so on, and so on, and so on. You know, keep moving forward. Keep towards the dream. Have a big dream, and keep pursuing it at all costs. Never, ever, ever give up on it. If you settle for mediocrity, one day that mediocrity will hit you in the face like a brick. It's that simple. Every day on Twitter, I'm not offering fish. Instead, I'm offering to show people how to fish. I'm showing them what's possible out there. If you think big, and you keep moving towards that big time thinking, it's only a question of time until every single one of you can make millions and millions and millions. But it takes effort. It takes great dedication. Like in this video, fuck the kids, he said. I'm not going to that extreme. The point is, you want to be successful, man, you've got to be committed. You've got to be dedicated to your craft. And I'm not just talking about spending hour after hour on a computer, but hour after hour, each and every day, trying to improve yourself. Trying to become the best you can become. All right, enough of me trying to give you guys inspiration. Let me get into some stock specifics that many of you probably want to hear much more than my trouble on the big picture. First of all, like I said earlier, my trading is built around entry points. Entry points to me, that's what separates me from everyone else. And everybody, you know, Dan is an example. Things about his trading separate him from everyone else. And Craig is an example. There are things about his trading that separate him from everyone else. These guys are successful. They're doing well, they're doing great. You know, and everybody has their own specific thing. Mine is entry points. So let me talk about entry points in a little bit more detail. Every single day, I try to understand what I can get away with and what I can't in terms of entry points. So before you can start looking at one particular stock and say, well, this is the right entry point, or this is it, first you have to understand the general picture. What is the overall market trend? Are we in a bull phase? Are we in a bear phase? Are we, continuously, pull back, rip, pull back, rip, pull back, rip kind of a scenario? How are small cap stocks performing in this kind of a scenario? Are they outperforming the overall market? Are they a hot sector right now? Or are they a cold sector? These type of things generally will give you an understanding how high your entries need to be safe, or how low they can be to still offer you a profit while not offering too much risk. For example, you have earnings season, okay, every single quarter. Now, during earnings season, what happens to small cap stocks? Small cap stocks are not the focus for that period of time of 6 to 7 weeks. While before earnings season, those 4 or 5 weeks before earnings season, they are the focus because there's not too much news out there on the earnings front. There are no giant earnings movers except for 3, 4, 5, 6 companies a day. So that means small cap stocks, whenever they have news, they are more likely to travel bigger distances than during earnings season. Because during earnings season, traders are focusing on many other stocks. Non-earning season, they're looking for the movers more. So they're more attracted to the subject. So therefore, during non-earnings, your entry point desired should be higher. While during earnings season with small cap stocks, you can probably get away with slightly lower entry points. Look at comparables in the small cap sector. See how much the other pigs have run recently. When I mean pigs, I mean jump stocks. See if they have had multiple day runs. How big of a size of a move are they? For example, let's say we have numerous stocks during a week's time where they have gone from 3 to 8 or whatever, or 9 in multi-day move. What does that mean? That means that the clown chasers that have been buying these stocks up, they are flush with cash. They are having a great week. What does that mean for the next time that some small cap has used? These same traders are more likely to chase even higher. Okay? Because they're used to it. They're seeing an immediate reward. Therefore, if you're looking to short, adjust your thinking, adjust your entry point to higher levels. If all of a sudden those same traders are getting pounded into the ground, and every small cap stock is a one-day wonder over a course of a week or 2 weeks, you can get away with much lower entry points. Okay, do you see what I'm talking about? I mean, it's that kind of outside-the-box thinking that you start as a general thing first of all. The next thing you need to look at is stock history. You know, whenever a stock has news, you need to understand when to attack it. You can attack it on day 1, day 2, day 3. By the way, my whole presentation is based on short selling. So I'm talking about strictly from the short selling point of view. So you have to look at what that stock has done in the past. On news that was somewhat similar. What kind of distances did that stock travel? And what kind of timing did that stock provide before the momentum broke? That's where charts can come in very handy. You look back, first you search the news, let's say you look back at the chart and you see on volume this stock moved over here. Okay, so right away let's say I'm briefing, I'll quickly do a search on that stock and go to that particular date and see what the news was. And see how relevant that news was and whether that move should have been justified, was justified, and how quickly it moved. History has a tendency to repeat itself. So if something broke, if there's a stock that over and over and over again, let's say 2, 3, 4 times over the course of the year, had news pop, and on day 1 was a one-day dog, that's a stock that you can short on day 1 if the move is up enough in pre-market. If that stock has a history of making a 2 or a 3-day move from the past, you need to be much more careful. You need to wait until day 2, day 3. Put that stock on your radar. Keep a close watch on it today. See where we are in the morning. The other thing is, charts are all different, yet many are the same. In terms of short selling, one of the things I look at is what does an actual 6-month chart look like? This helps me understand where my entry point needs to be. So what I mean by this is, let's say you have a stock that has been trending down for a 6-month period. And now, all of a sudden, this garbage company puts out some pumpkins. Okay? And now the stock pops. Now, the important thing, you looked at this 6-month chart, now what does that tell you? Over a 6-month period, buyers have been spanked to death. fried, deep fried. There's tremendous overhead resistance. These same buyers over a course of 6-month period are deep underwater. On any spike, they're looking to get out somewhat unchanged or near unchanged. And if by miracle they can get a profit, they'll be thrilled. Overhead resistance. That stock is much less likely to have a multi-day move because there's so many past bag holders. Therefore, your entry on the short side can be less. At the same time, if the stock does not have past bag holders, you need to be much more careful. You need to wait for multiple day one to even consider it. Even if the news is necessarily stupid. Maybe wait for day 2. This is the type of general thinking you need to look at before you even start looking at specifics. Next thing is, you need to understand the news. One thing Dan does, that I can tell you for a fact, probably the best thing he does, is he is able to decipher news. Okay? He does it very well, and that's his strength in trading. You need to understand what the news means. There's so much stupidity out there. Repeat news. I mean, things that make no sense, no logical sense, why they run, yet traders chase simply because the stock's moving up, for no other reason. If you can come to understand the news, you're halfway home. Because at least then you know which way you can trade that stock. Now, personally, the timing of the news, I'm much different to Dan. I'm not looking for timing of the news. I learned a long time ago, I am never going to beat any speed traders out there. I'm not going to beat the machines out there. I have seen traders be so fast on news that has blown my mind. I'm not going to beat these guys. So whether I get something in 30 seconds, a minute, 2 minutes, or 5 minutes, it doesn't matter. I'm not looking to chase a stock up. I don't care about that. Okay? I'm looking to fully understand the news. And if I fully understand the news, it meets all my other criteria, then I make a plan of where I want to trade that stock. So it's very important to understand the news. And if that's something that you struggle with, that's something you need to work on a great, great, great deal. Now, one thing that's important is understanding the concept of measured moves before you consider entry points. For example, let's say a stock went from 3 to 5 overnight and it closed high of the day. Now that's a $2 move on a $3 stock. Now that's a lot of momentum if it closed high of the day. If the news was somewhat sexy to other traders, but you know it's stupid, and that stock's gapping up, significantly, you got to look at it in terms of measured moves. So what is a measured move for day 2? A measured move for day 2 is anywhere between 50% of day 1's move to 100% of day's 1 move. Okay, depending on the story, depending on the stock. So if something is on day 2, early on, let's say before 10 o'clock, and that same stock went from 3 to 5 and now 5 to 7, and I know it's stupid, the news is so that came yesterday, this is the second day of a significant measured move, I'm going to try to short it. I'm going to try to fade it right there and then. Will it work out? Chances are it will. But this is a setup probably 75% will work. Now, that same theory, now let's say it doesn't work. My mindset is then turns to with day 3. Because I know, as I explained to you guys earlier with the ball, day 3 in poker terms is the nuts. Okay? That's when you have a hand that cannot be beat most of the time. Okay? So on that move, I have over the years developed several theories, and one of them that I developed and made myself is called the gravitational theory. And it goes back all the way to 1998. Okay? And that is a stock that makes a measured move day one, similar measured move on day two. On day three, in general, if you take the total sum of the move from start to the close of day two, you divide that by 4, and you add that to day two close, that is a very, very strong entry point for a short play. A one that is highly likely to be profitable, and one that you can actually add to if the shares spike even higher before 10 o'clock. Now, there's two specific things that you need to understand about this gravitational theory. And once again, it's measured moves. Now, let's say the first move, the first day, the stock went from 3 to 6. The next day, the second day, it went from 6 to 750. So first day was plus 3, second day was plus 1.5. Okay? That means overall momentum is less on day 2. Okay? So now for day 3 as an example, if you're looking to short it, I take the whole move of both days and that would divide it by 3. Simply because momentum is slowing. Now the same thing, let's say the first day the stock went from 3 to 5, a 2-point move. And on the second day it went from 5 to 8. That means momentum is gaining from day 1 to day 2. So if I'm looking to trade that stock on day 3, and I'm looking for what I call ideal entries, I take the whole move from day 1 and day 2, add them together, and instead of dividing by 3 or 4, I divide by 5 or 6, depending on how I feel about the stock, to come up with what I call our absurd entry points. Okay? Now, you give me those situations 10 times, and out of those 10 times 2, 3, 4, they're going to find my desired entry point. And I'm going to be handling that stock. And if it doesn't get to my desired entry point, I might trade a significantly less size, or I'll leave it alone completely. I don't care. Every trade has to be on my terms. Okay? I don't fit my strategy to the stock. The stock has to fit my strategy. Otherwise, it passes. That's why I don't trade 10 stocks a day or 15 stocks a day like so many traders do. I trade 2, 3, 4. My average is about 3. And out of those 3, usually only one when I truly trade size. The other ones, they have a little screw around it. Maybe trade size, maybe not. I am highly, highly, highly selective. Now, this gravitational theory specifically applies to day 3 in measured moves. Day 3s don't come around that often, and when they do, they're often golden opportunities. Now, the next thing is, before you can debate and come to an entry point, you have to think about the stock itself, about how thin it is, what the flow is. These things are crucial, what the market cap is. Okay? You have to try to understand the news itself. Of course, you already understand that, let's say. But now you have to understand, how is this news, the size of the move, impacting the market cap? Is it reasonable? For example, let's say a company that has a $140 million revenue run rate announces a contract for $4 million. And they have a market cap, let's say, $100 million. And all of a sudden the stock rises, $40 million over a course of a day or two. Well, does that make any sense? A $40 million market cap or $4 million contract. There's probably, maybe net profit amounts to, I don't know, 20% of that $4 million. So you have to think, you know, what does it mean to the market cap? The reason why you look at why does the stock, whether the stock is trading thin or not, what the float is, for me at least, it matters a great deal because then it allows me to judge what kind of size I am able to trade. The ability to get in and the ability to get out in case I'm wrong. Those are very important things. You know, it will save me stress if I know right up front that this is the maximum amount of shares I'm willing to trade. And I will adjust my ads and the amount of size of those ads accordingly, because I know up front how much total size I'm willing to share based on the flow and based how thin the stock is. The other thing is the volume. Now, I am not a big believer in volume. There are many traders out there that feel very strongly volume is crucial. You look at the volume. The only real reason I look at the volume generally is because if there is no volume, I'm not interested in trading the stock very much. Because volume gives me an opportunity to get in and out. I think volume overall is highly overstated, especially these days. It wasn't so much a decade ago or even earlier, but now because of computerized trading, volume brings in computerized volume. And that's kind of empty volume. You can't really think of that. They wouldn't be coming if the stock wasn't having some volume to start with. So volume is kind of a, like I said, it doesn't mean too much to me. I don't put much stock into it. Although, when volume does explode in certain situations, and it trades 40 times its usual, or 50 times, or 100 times, and it does that for several days, my train of thought right away is, well, you know, who the hell is left to buy this thing? It's run for 2 days in a row. Incredible. Who's left to buy this stupidity? So I know day 3, I'm coming. Just a question of